Hey, good evening, everyone. This is Kevin with RealTradersWebinar.com. First off, we just want to thank you all for coming out and joining us on a Thursday night. We know you guys are busy. You have busy schedules. We really appreciate you taking the time to come and join us. Tonight, we have with us one of the most well-respected and top trading instructors and traders, Barry Burns. Barry's been trading literally about his whole life. His dad was a trader. So Barry started trading at the age of 8 years old. Barry's also the president of Top Dog Trading. And tonight he's going to be sharing with us how to time your entries and exits with Swiss clock precision. So without further ado, I'm going to hand it off to Barry and let Barry take it from here.
So I stopped that and another company, Worldwide Traders, they invited me to do seminars around the country. And so I thought, well, that's great because then I can spend, that time speaking to a lot of people all at the same time rather than just doing it one-on-one. So I ended up doing that, do the seminar circuit, and that was fun for a while, but I had a young family at the time, so eventually I got tired of all the travel and being away from home, and so I came back home and got back to just doing my own trading, and then I got approached by FuturesTalk.net. They wanted me to be their head moderator of their chat room, and so I did that for a number of years. Went on and got my doctorate in hypnotherapy and got certified in neurolinguistic programming so I could help people with the psychology of trading. Well, I've been featured in several books using candlestick charting and also the Complete Guide to Investing in Derivatives, and oh gosh, about 6 or 7 pages in each of those books about me and my methodology. And for quite a few years now, I've been first runner-up Reader's Choice Award for technical analysis websites and also trading or educational schools, and that's by Technical Analysis of Stocks and Commodities magazine. But I'm especially proud of that one because I'm not a company, I'm just a trader, one-man operation here, and I've got a few people who handle phones for me part-time, and that's it. So I don't have any sales department, marketing department, none of that stuff. And so to be able to compete against major marketing companies and still get first runner-up year after year after year, that's voted on by the traders, by the students. So it really means a lot to me. And if you want to read my whole bio, just go to my Top Dog Trading website, click on the About button at the navigation button up there, and you can read all the other details. But that just gives you a little brief idea of who's talking with you today. Now, time to make one of the most important people in our lives happy. And of course, the most important person in all of our lives is our warm, loving, kind-hearted, sweet, gentle lawyers. And yeah, I'm not the biggest fan of lawyers, but actually I have a couple friends who are lawyers who are great, great people. And I make fun of it, but truly these disclaimers are really, really important. Not only for legal reasons, and yes, they are here to cover my butt. I'm very honest about that and upfront about that. But these statements were not created to protect me. They were created to protect you. And they came out of bad experiences of other people. So I want to be very clear, because this is really where your education begins, is to face trading realistically. I'm really against hype. I'm not even going to try to sell you anything today, so you can put your pocketbooks away, your checkbooks away. I'm not going to ask for any money today at all. I'm going to be giving you some really, really great free stuff. This is anti-hype. This is total transparency. And in fact, I'm a terrible salesperson, as you'll find out here in a minute. So let's talk about the reality of trading. The truth is, trading is not suitable for all people. In fact, the vast majority of people lose money trading. Don't know how much more clear I can be than that, so I'll say it again. Most people lose money trading. So if you hear anybody say, oh my gosh, everybody's making money with this trading system, I've even seen ads like this, 100% success rate, run away. That is not true. So be very, very, very cautious and understand that trading is risky and most people don't make money. Also, be aware that markets are leveraged, or some markets are leveraged, and so it's possible to lose more than the amount of money deposited for a position. Now, The person to talk to about that is your broker. They can look at which markets you're trading and what margin or leverage is available on your account, and they can tell you what your maximum risk exposure is. And that's what you need to know. What's my maximum risk exposure here? Also, a person should only use funds they can afford to lose. We call that discretionary money. So you do not want to be trading with money you need for your retirement or your kids' college education or to put a roof over your head or food on the table. All information in this presentation is for educational purposes only. I'm not giving specific buy or sell investment advice. And the information in this presentation, of course, is entirely at your own risk. It's for general purposes only. We assume no responsibility or liability for errors or omissions. And we do highly recommend that you seek the services of a competent professional financial advisor before investing or trading. There. Okay, let me look over across the room here. Yep, my lawyer is smiling ear to ear. So I guess we did something right. All right, but again, all kidding aside, folks, seriously, most people trade or take trading to be some kind of get-rich-quick scheme. It isn't. It is not. It is a profession. And like any real profession, it takes time, takes dedication, focus, education, experience in the sense of screen time. So don't rush through it. Don't have unrealistic expectations, and protect yourself, protect your money. Okay, now let's jump right into it. So that I know how to customize this presentation a little bit for you, I'd like to get a little feedback from you and just kind of learn a little bit of who you guys are. If you would, just type into the question box there what market you trade. And you can list more than one if you want to. Do you trade stocks, futures, options, or Forex? And this helps me to customize my terminology for you today. So if we have mostly stock traders, I'll talk in terms of shares. Forex, I'll speak in terms of lots. Futures, I'll talk in contracts, you know, things like that, just so I can use the terminology that you guys are comfortable with. Wow, well, you know what? We got people doing everything. Okay, so I'm getting a lot of answers here. Thank you very much, by the way, for your participation. You guys are really paying attention, and you are here. I really love that. So thank you for your participation. However, there is no consensus here. We got people treating everything. Okay, so well, that's good to know. And one last question for you guys. Are you mostly day traders, swing traders, or investors? Day trading just simply meaning you're out by the end of the day. Swing trading, you hold overnight, 1 or more days, and investing, I interpret that as holding for a year or more to get long-term capital gains. Okay, so here we go. We got a lot of day traders. We got some swing traders. We have some people who do both. And not so many investors. Okay, that's pretty typical. That's pretty typical of what we see. Okay, so most of you are day traders, but we do have a healthy number of swing traders as well. Okay, great. Thank you very much for that. Oh, I do have one last question. And again, this will help me customize the presentation for you, and I'll explain how this will allow me to customize the presentation for you. Here's the question. What are the most common trading problems, struggles, or frustrations that you have? Now, go ahead and type that into the question box. And here's how this will help me. When I come to a slide, obviously my slides are pre-written, but when I come to a slide that addresses a topic that a lot of you have said is a problem, I'll slow down and I'll talk more about that topic. On the other hand, if I come to a slide that covers a topic that none of you have mentioned as a problem, then I'll go through that slide real fast, or I might even just go ahead and skip that slide. So that's how it will allow me to customize the presentation for you today. Okay, so let's see. All right, we got a lot of answers coming in here. I'm not going to be able to read all of them, but what I'll do is I'll just read ones. I'm sure there'll be a lot of repetition. Timing entries and exits. Getting your stops hit, losses, exits, letting losers run, and then getting out of the market too soon when you're making money, all right? Projecting exits. When you go short, the market goes up. Having more winners than losers. Not enough time for options to work out. Getting stopped out. Getting stopped out. Recommendations from newsletters are losers, not the winners they promote. Yeah, I found that same thing, Tamara. I don't rely on any kind of newsletters or experts anymore. I haven't found any of them to be worth a hill of beans, at least none of them that I've tried. I'm sure there's some good ones out there, so I don't want to make a universal statement, but I haven't found them. So that's why I'm so intent on empowering people to make their own decisions. Staying in too long, hesitating on entries, discipline, sticking to my rules. That's a good one, John. Yeah. Not knowing when the trend ends. The market doesn't agree with me, says Robert. Yeah. Well, yeah, that's right. The market doesn't really care what any of us thinks, does it? The whole idea is to go with the flow of the market. I'm going to show you how I do that today. Market goes opposite to my trade, says Dean. God, we got a lot of answers here. Giving back my gains by staying in too long. Pulling the trigger. Okay. It's hard to buy to enter the market. Stops getting hit again. A lot of people having, this person says, Dave says, stops not a problem, but getting on the right side of the trade is a problem. Okay, we're going to talk about that. We are definitely going to talk about stop losses, and we're going to talk about how to get on the right side of the market. Chasing the market, getting stressed out and can't follow his plan after he gets stopped out, whipsaws, over trading. Okay, wow. All right, there's so many answers here. I'm not going to be able to get to all of them, but a lot of common ones. So here are some of the most common answers from people who have attended this webinar in the past. So this is going to be very instructive for you. Most common answers to the question from previous webinar attendees. Number one, they say, well, I enter the market, then right after I get in, I get stopped out. Then after I get stopped out, boom, the market turns right around and goes back in my original direction of my trade. Does that sound familiar? Quite a few of you mentioned something to that effect, maybe using different words. Here's another one a lot of you mentioned. Getting out of big moves too soon, it's so not making the huge profits, not letting your winners run. A lot of you talked about that. Getting stopped out too often. Oh my gosh, that was one of the most common ones that you guys mentioned here today. Buying off support that doesn't hold the market. Trading a trend that doesn't follow through. That's a directional issue. And again, a lot of you mentioned the issue of getting on the right side of the market. That's a directional market or a directional issue. So the reason I show you this is to encourage you that your issues, your problems, your struggles and frustrations are not unique. Trading can be a very isolating activity as we sit in our offices or our homes and we trade, and we can start to think that our problems are uniquely ours and that there's something wrong with us. No, these problems that you've mentioned are common among almost all traders. So we all have our own little special issues, but these themes that you've mentioned are common to all traders in general. Now, even profitable traders, I mean, I've struggled with these same things, and so have other profitable traders. But the key is there are answers. And we've gotten to the other side of these problems with solutions, and I'm going to give you some of those solutions today. So let's jump right into it. And what I'm going to do for about the next 25 minutes, I'm going to share with you an overview of my entire trading methodology. And then the last 15 minutes, we're going to focus down on timing, on the timing of your entries and your exits specifically. And not only am I going to talk about that, I'm actually going to give you today my timing indicator. Absolutely free. You're going to get it here today. And you get it in the next 40 minutes. I'm going to give it to you, but then more importantly, I'm going to show you how to trade it. So you can actually start trading it tomorrow if you want to, if you like this. And it is amazing. This timing indicator, well, I used to just sell it. And now on these webinars, I'm giving it away to people because a friend of mine said, whatever's the most valuable thing you have, you should just give it away. And I like that. I think that's a good spiritual principle. And so that's what I do now. This is one of the most valuable things I've ever come across in my life. The accuracy of this timing indicator is absolutely amazing. It's incredible how accurate it is. But the timing indicator, or timing in itself, is just one part of an entire trading methodology. So that's the reason I'm going over my entire trading methodology first, so you can see how the timing aspect fits into the big picture. Because timing by itself isn't going to help you. You need everything. Successful trading is never about any one thing. Successful trading is about putting together a methodology of a number of variables that those variables then put together put the odds on your side. Okay, they give you a probability scenario. And that's what makes trading different than gambling. You go to slot machines and you gamble, and you know the odds are against you. They are built into the machine to be against you. In trading, you can create a successful methodology where the odds are on your side. So my trading methodology is all about one thing: measuring what I call the energies in the market. So what are these energies? Okay, let's first just list them. All right, I'm going to start with generalities. I'm going to get more and more specific as I go through the webinar. So you probably have questions at the beginning while I'm giving you the big picture. Hold on to those questions, because most of them will be answered as I get more and more into the webinar and I get more and more detailed. And at the end, though, I will stick around and I'll be happy to answer any questions after the webinar is over. All right? So what are those 5 energies? Here they are. Let's just list them first. Number 1, trend. That's direction. And by the way, I'm looking for these energies in this order. So every time I'm looking to take a trade, I'm going through these 5 energies, counting to 5. Number 1, my first decision is, am I looking to buy or to short? Number 2, what is the strength of that trend? That's energy number 2, momentum. Number 3, this is where timing comes in. See, timing doesn't come in until the third part of my decision-making process. So once I've got a trend and I've determined it's strong, then and only then do I ask myself the question, okay, when do I want to enter that trade? Number 4, I'm not a breakout trader. I like to buy retraces. So I need to be buying off support or shorting off resistance. So that's the 4th energy. And the 4th energy is a blockage of the first 3 energies. So I have something for the market to bounce off of and go back in the direction of the trend after a retrace. And finally, the 5th energy I call the fractal energy. And that's just a fancy term for looking at the same thing on a different scale. And in trading, that translates to using multiple time frames. Now, that's a very common practice in trading, but as you'll see, I do it differently than most people. So when we get to that point, we talk about the details of it. I'll show you how I do it and why I do it differently than most people. Okay, so that's the list of 5 energies. Now, the next question is, fine, how do we measure those energies? Because I want my trading to be objective, rule-based. I don't look at a chart and just out of my discretion say, oh, well, let's see, this market's going up, and say we're in an uptrend. No, I need some objective rules, and for those objective rules, I need objective instruments to measure those energies for me. So again, let's just list those energies real quick, and then we'll get into the details of them. So the instrument for measuring trends is a moving average. For momentum, of course, it's a momentum indicator. For cycles, I'll be giving it to you. It's an oscillator. For support resistance, I use previous cycle highs and lows, previous wave highs and lows, floor trader pivots, and Fibonacci levels. And then for fractal energy, for day trading, I use a chart interval 3 times the setup chart. So as an example, if I'm trading a 5-minute chart, and that's my setup chart, then I will also look at a 15-minute chart, 3 times 5. And that 15-minute chart is my fractal energy. And again, I'll show you how I do that when we get to that. So what's the purpose of measuring these 5 energies? What's that all about? Why are we even doing it? We're doing it to determine a probability scenario. Probability scenario. See, in trading, there's no certainties. The market can do anything at any time. That's a very popular trading saying. Market can do anything at any time. Very true. So the best we can do is establish probability scenarios and then manage our risk and manage our money. So the question, of course, becomes, well, fine, excuse me, how do I determine a probability scenario? How do I make sure the odds are on my side? Well, the way I do it is, at each potential entry point, I ask myself one question. How many of those 5 energies are aligned, all saying buy or all saying sell at the same time? Based on that, I give each setup a score of 1 to 5. Obviously, the higher the score, the higher I consider the probability. I liken this to taking each trade to court. I'm looking for 5 independent witnesses to establish a preponderance of the evidence. Now, the operative word here is independent. You see, if I were to use 5 trend indicators or 5 momentum indicators, that wouldn't really be very useful because they're all measuring the same thing. What makes this work so well is because I'm using instruments or indicators that measure 5 energies that are all different. They're uncorrelated to each other. So in other words, trend is not correlated to momentum, and momentum is not correlated to cycle, and cycle is not correlated to support resistance, and that's not correlated to fractal. They all measure very, very different things. They're completely different energies. So just as a quick example, and you'll see this on some of the charts I'm going to show here in just a second. So if price trend is up, sometimes you'll look down at momentum and you'll see that the momentum indicator is also up. Other times price trend is up and you look down at momentum and the momentum indicator is flat. Yet other times you'll see price trend going up and momentum is actually going down. So there's no correlation between those 2 energies. And there's no correlation between any of the 5 energies. They all are independent of the other 4. That's what makes it significant when they all agree. That's when the odds are on your side. So that's the whole psychology or the logic behind this methodology. So I do not rely on any one indicator or any one energy. There are some people out there who say, oh, you know, indicators are no good, they're lagging, blah, 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 whatever. They just trade price pattern. Well, that's great. I agree with them about 3/4, but not completely. Because I do agree that no one indicator will make you any money. So, and I don't agree that any 2 indicators will make you money or any 3. So in my method, we have a requirement that at least 4 of, again, the independent indicators that are not related to each other all agree, 4 out of 5. Only then do we give them any significance whatsoever. Otherwise, completely useless. Okay, that's a very, very important issue to remember. So let's go back through those 5 energies now. Let me show you some charts. Let's bring some visuals up and let's get to the next level of detail. So energy number 1, trend. Trend simply refers to direction. So here's a sample of the euro. And let me bring my little spotlight up here. Okay, so the 50-period simple moving average is the instrument or the indicator that I use to measure trend. It's the red line here. It simply gives the overall direction of the market. Now, the orthodox definition of trend in technical analysis that you read about in a lot of even old textbooks and new textbooks is that an uptrend is defined by higher highs and higher lows. And here we do. We have a higher low, higher high. But is this really the trend of this market? I say no. No. For 2 reasons that does not serve us well. Number 1 is just pure etymology. The dictionary definition of the word, and this is Webster's dictionary, is that the term trend means to extend in a general direction. All right, think about that. To extend in a general direction, just to add overemphasis. So trend means the long-term direction of the market, not short-term. This is the short-term direction of the market. This is just a complex retrace up in the extended general direction of the market, which is down in the 50 simple moving average, shows the direction is down. That's the trend. So number one, just the etymology of the word. Number two is a business reason. We want our winners to be bigger than our losers. So we want to trade in the direction of the long term, the extended movement of the market. Because if someone bought this low, someone might even mistakenly think, oh, that's a reverse head and shoulders. Here's the left shoulder, there's the head, there's the right shoulder. Okay, number one, they'd be wrong. That is not a reverse head and shoulders pattern. It does not fit the definition of the price pattern. Number two, just because we have a higher low does not mean we have an uptrend. Again, as I explained, that's a wrong definition of the word. But the good news is a lot of people will buy this for that because they've got a mistaken idea. And what we will do is we will fade them. We will take the other side of their trade. We will short here or we will short here because we see the extended general direction of the market with the 50 simple moving average is down. That's the direction we want to trade. And that gives us a much bigger reward. Bigger reward. So small risk, big reward. That's what we're always looking for. And that's why it's so important to have a correct definition of trend. Not little short-term moves, not short-term moving averages. Short-term moving averages will just follow price. We don't care about that. We want the longer term. That's why we use the 50 period moving average. Also, anytime you see your indicator and price doing something different, take note. Take note. That's something you should always watch for. So here, yeah, we have a little price movement up while the 50 MA is going down. That's a clue. Now, see, if people are just trading price pattern without any indicators, such as the 50 MA, they're not going to see that. They won't know that the direction of the market is down. Okay, energy number two. Now, see, trend just gives direction. And again, by itself, the 50 MA, meaningless. Doesn't help you at all. It's just one piece of evidence. Remember, we're looking for 5 pieces of evidence, preponderance of the evidence. One piece of evidence, not enough to make a decision, not enough to put the odds on your side. So we look at energy number 2 now. And what we see here is we have a higher high, higher low. Then we do make a higher high. So if we bought that low, that'd be good. Then we get another higher low. So price pattern is still up. 50 MA still up. At this point, if that was the current time, the hard right edge of the screen, is trend up? Yes, it is. At that snapshot in time, trend is still up. The problem is trend in itself, whether it's by price pattern or by indicator, is lagging. It tells you what's going on now, doesn't give you any indication for the future. So did some people buy this? Oh, they sure did. 2 green bars after that, but then we make a much lower high. We take out this low, so stops are taken out, and the market turns completely around. So the obvious question then is, well, how would we have an indication that it would be good to buy this higher low, but not buy that higher low? And the answer is momentum. So if I take my curtain off of my momentum indicator, we can see at this higher low, when we go down to our momentum indicator, it's holding above the 0 line. And that indicates that momentum is strong. So the trend at this low is a strong trend. We only want to buy strong trends, not weak trends. Higher high on price, equal high on momentum. Higher low on price, lower high on momentum. And momentum goes down to the 0 line, meaning there's no more strength in this market. And so now the strong trend has turned into a weak trend. We don't buy weak trends. And that's what would determine that we not take that higher low and buy it. In fact, we might, because of momentum actually being able to lead price. See, again, the indicator is showing you something different than price. And remember what I said, always look for where your indicators diverge or show something different than your price pattern. There's usually a clue there. So now we would actually be able to look and say, oh, maybe I'll take the opposite side of the trade because I can see something other people don't see. Maybe I'll short here or here or even here. You've got 3 opportunities to take the other side of the amateur's trades who are just trend trading. Okay, energy number 3 is cycles. And as I said, this is the 3rd step of our decision-making process on every trade. Number 1, direction. Do I want to buy or sell? Number 2, okay, is that trend strong or weak? I'll only buy it if momentum says the trend is strong. Number 3 then is, okay, when do I want to enter? Because markets wiggle up and wiggle down. They don't go straight up or straight down. You know what? We're running just a little behind on time, so I'm going to skip this slide because we're going to come back to this, and we're going to spend the last 15 minutes, and I'm going to go in detail on cycles and give you my cycle indicator. So we will go into that at that point. Energy number 4, support resistance. Now, here I have Fibonacci levels. Just looking at the chart, you can see that price goes through some Fibonacci lines and bounces off others. Question, of course, arises, how do we determine which ones are likely to bounce off of and which ones are likely for the price just to go through? Again, by itself, it's useless. You don't know. So we just have to look at aligning our energies. So let's just, for time's sake, look at this last arrow here. So here we come up to a resistance level, this blue line, and that is actually a cluster of resistance. It's this wave high and the 50 Fibonacci level. Since a cluster, we consider that a stronger resistance level. Then we have an engulfing candlestick high. We see our cycle indicator turning over, turning red, so indicating again it's time for a high to be put into the market. So timing along with the resistance level, along with a candlestick pattern. Oh, by the way, the 50 MA is also angling down, so the direction we're looking to trade is short. And when we look at momentum, where's the strength of the market? Well, when the market moves down, the momentum indicator pulls far below the 0 line, far below the 0 line. When the market goes up, it barely gets above the 0 line. So moves up are weak, moves down are strong. So everything is aligned to go down. And finally, the fractal energy. Okay, now I promised I would share with you how I do this different than most people who trade multiple time frames. So let me do that right now. So here, this would be our setup chart, 100-tick chart, and your fractal chart is 3 times that, or 300-tick charts in this case. So we've got price above the 50 MA, which is our directional indicator. Then it meanders below the 50 MA. So now we're looking for shorts. Okay, here we get, by the way, the 50 MA can also provide resistance, as it does here. We get an engulfing candlestick again, candlestick high, cycle high, momentum below 0. So again, all the energies are aligned to go short. Then, before we can take a trade, we must have the fractal energy confirming the trade. In my method, the fractal energy, the next higher time frame, is not optional. Now, how do we confirm it? The way that a lot of traders do it with multiple time frames is they say, I'll only take a trade in the direction of trend of the higher time frame. Now, here's the reason that I don't like that. Number one, the higher time frame obviously is slower. In this case, 3 times slower. So we're going to only get 1 bar here for every 3 bars on the setup chart. Number 2, as we've already shown, trend is a lagging indicator. So why would I want to confirm my trade with a lagging indicator on a 3 times slower chart? You see, the timing between the two are just too loose. It's too loose. So I actually want to do the opposite. On the higher time frame, I want to use the potentially leading indicator, the faster indicator, which is momentum. So since I'm looking for a short here, all I need to see is that momentum is down on the higher time frame on my fractal chart. And I also like to be trading in the direction of cycle on the fractal chart. So that's basically how I confirm my trades. Very simple. Just trading, make sure I'm trading in the direction of momentum and cycle on the higher time frame. Trend, I don't care what it is on the higher time frame. It's too slow. Okay, so let's put it all together and just show you how really pretty simple this is and how I would analyze a trade. So we've been going down, 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 down for a while. I have a rule that the longer the trend continues, the less likely I consider it will continue. So when I trade with a trend, I only want to trade early in a new trend. So now I wait and we get the price breaking above the 50 MA. Great, starting a new trend up. And it retraces. Remember, I like to buy retraces, buy low, sell high. I'm getting wholesale prices down here. I'm getting in before the breakout traders. Breakout traders enter here, I'm already in. By the time the breakout traders come in, they're adding to my position, basically. In other words, they're continuing to push the market in my direction, which is why I love them. Yeah, keep pushing the market in my direction. Thank you. But I want to get in down here. So what we do is we just go through our 5 energies, and again, I always go through them in the same order. All right, so we're early in a new trend. I will only buy or sell the first 2 retraces in a new trend. This is the first retrace. So trend, yes, we got trend on our side, number 1. Now, is it a strong trend or a weak trend? Momentum, that's our second energy. That's our second question. Look down at our momentum indicators holding well above 0. So yes, it's a strong trend. Okay, we got 2 out of 5 energies. Cycle low, yep, angling back up. Great, we got 3 energies. Timing. Number 4, we're bouncing off of the red line, which is the 50 Fibonacci level. So even though we have a retrace here, we have a support level to bounce off of. So yes, we have 4 energies. Now we go to our next higher time frame. Now if you notice, the 50 MA is angling down here, but I'm looking to go long. So I'm trading against the trend in the longer term time frame. But I don't care, because that's a lagging indicator on a slower chart. So, and remember too how I showed you the trend and momentum could be going in different directions because they're independent energies? Well, here you go. Momentum's going up, trend's going down. So all I care about is that the potentially leading indicator momentum is going in the direction that I want to trade in, and cycle is too. So therefore, that's the 5th energy. The trade is confirmed. It's a 5 out of 5 trade, and I could take that. Okay, so that's it. Now, let's move on, and let me focus on the timing aspect of it. There's 3 parts to this final section. Number 1, we need the right indicator, which I'm going to give you. We need the right inputs. We're going to make some changes to that indicator. And then, even that's not enough. Giving you the right indicator and the right inputs would not help you in the least. Number 3, I need to teach you how to trade the indicator, the right technique. Fortunately, I am going to do that today as well. I'm going to do all 3 of these things for you right now. Okay. Oh, you know what? Yeah, I had the slide in here, the order chaos cycle. We're going to skip this one today. All right, because I just want to make sure I get enough time here and also some time for questions at the end. I do another webinar on other types of cycles, and the order chaos cycle is part of that. So here's what we want to do. And you might want to write this down because this gets very, very specific. So the indicator that I use for cycles, ironically, is the stochastic indicator. Now, I say ironically because the stochastic indicator is not a cycle indicator at all. It's not. There are indicators created to be cycle indicators. Stochastic is not one of them. If you look at the mathematical formula, it's actually a momentum indicator. Now, the interesting thing is I've bought a lot of those cycle indicators that were created by really some very intelligent people, geniuses. And I'm not saying they're bad, but I've just come back to this because I found a way to trade this that works better than any of the cycle indicators I bought. And the reason that it's so good is actually because of the momentum aspect to its formula. So I'm going to show you why that's so important here. Now, because it's not a cycle indicator, we do have to make some changes. Oh, by the way, we're just using the good old-fashioned stochastic indicator created by Lane. So we're not using Stoch RSI or double stochastic or any of the other fancy ones. I mean, those are fine, but for our purposes, we're just using the traditional stochastic indicator. If you have a choice between fast or slow, choose slow. But then, to turn it into more of a cycle indicator, we need to make some changes. So period D, or sometimes it's called percent D, you want to change that value to 3. Whatever your default value is, change it to 3. Period K, or percent K, as it's sometimes called on some charting platforms, we're going to change that to a value of 5. Smoothing, or some charting platforms call it average, change that to a value of 2. The other thing we're going to change is our upper and lower horizontal lines. We want to change those to a value of 20 and 80. 20 and 80. Also, you want to make sure that the indicator calculates intra-bar, that it doesn't wait until the bar closes to print the indicator on your chart. So you will actually be able to see it flickering up and down as the bar forms. Okay, so that's the indicator, and those are the inputs. Now, let's do a quick little review because I find that people forget this. People get so enamored with indicators, they think they're the Holy Grail or something. This is not the Holy Grail, but it's very powerful in its context. So, got the right inputs. Remember, by itself, this is only measuring one energy, and any one indicator or one energy does not help you make money. So we only use it strategically with the other energies. With cycles, what that means is we're not going to buy every cycle low or sell every cycle high. We're only going to trade the cycles in the direction of the trend early in the trend. And early in the trend is defined as the first 2 retraces in the trend. We're only going to trade the cycles that have momentum behind them. We're only going to trade the cycles that have the fractal energy aligned. Remember, alignment of all these energies, preponderance of the evidence, uncorrelated energies all agreeing is what creates significance. Now that's all review. Here's the new one. We're only going to trade what I call second chance indicator patterns. Okay, I haven't covered this yet, so this is new. Second chance indicator patterns. So what is this? A second chance indicator pattern, what it's really doing is it's indicating a momentum shift, a little typo there, should say shift, not shirt, a momentum shift at the top or the bottom of the cycle. Remember how I said stochastic mathematically calculates momentum? Okay, so here's where that becomes critical. This is why this works so well. This is why it's so accurate in finding cycle lows and cycle highs. The final low, the final high, so you don't get stopped out so often. That's the point here. So right now I'm going to show you the mini divergence pattern. There are 5 other second chance patterns. There's actually a total of 6 second chance patterns I've documented. And again, what are these for? They're to help you find extreme high probability that you found the final cycle low to buy or the final cycle high to short, so you're not getting stopped out. That's the significance of this. And it's super, super high probability when you do it with the other energies. Okay, the easiest way to do this is just show you a chart to do it visually. So let's go for it. All right, so here's our stochastic indicator, and this is a chart of the stock Verizon. It's a 5-minute chart, 352. There's our new inputs. Now, let's talk a little bit about this indicator, though. As you can see, price is going down, 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 making lower lows over here on the left of the chart. On the other hand, our stochastic indicator is just bouncing around the bottom. It's not making lower lows. Why? Again, if you look at the formula for stochastic, it's what we call a bounded indicator. And what that means is the mathematical formula restricts it in its valuation. It's only allowed to go to a low of 0 and to a high of 100. So once price pushing down brings it down to 0, if price continues to go down to 0, or continues to go down, I should say, the indicator can't go below 0. Mathematically, it's not allowed to, so it just bounces around the bottom here. Now, what are some of the traditional buy signals for the stochastic indicator? There's primarily 2. One is when K crosses back above D. In this chart, K is the black line and D is the slower blue line. Another traditional buy signal is when the indicator gets below the lower horizontal line and comes back up above it. But if you used either one of those traditional signals, well, here you'd be stopped out, here you'd be stopped out, here you'd be stopped out, here, okay, here the market finally goes up. So you'd have 3 losses before a win. So the reason those signals are bad, again, is just because it's a bounded indicator. So these crosses of the 2 lines or below the horizontal line moving up, meaningless. Again, when we come to a high, okay, we get a sell signal, but the market goes up, makes a higher high. Another sell signal. Again, the market goes up, breaks this high. You would have gotten stopped out 2 times, and that's the whole point. We don't want to get stopped out. We want to short the highest high. We want to buy the lowest low. So what does work is looking for a momentum shift. Remember, momentum can lead price because it starts to show weakness in the move. So even if you're trading price pattern, how would you know which is going to be the final high? Again, look at where your indicator tells you something different. This is what I call the mini divergence. Higher high on price. Now, what we're looking at is percent K, the black line, the faster line. We've got a lower high on percent K. That's your divergence. Momentum, stochastic indicator in this case, is leading price down. It goes down, makes a lower low before price does. And because it's way down here at this value, it's not way up here at the bounded edges of the indicator. So it has meaning down here at this value. So it shows us the weakening of this move up, and therefore we can have a high probability that's the final cycle high to short. And we wait for that. We wait for that. Now, I call this a mini divergence. A lot of people teach divergences, but most of the time what they're talking about is the difference between this high and this high over here, with the indicator going all the way down to the trough in between. Personally, I have not found those to be real consistent, and so I don't trade those. I call this a mini divergence because the 2 highs are very close together in time, and the whole indicator is in the top part of the range. The whole thing. It does not go down in between the 2 highs. So it's just a mini little momentum shift, and that's significant. Now, this is a scalp trade. Okay, this is in for a free 5-day video course that's totally free, just a service to the trading community. And I teach this trade, and I call it the rubber band trade. It's a reversion to the mean type trade. So this trade, the setup, since we've been in a downtrend for a long time, as I said, the longer we continue in a trend, the less likely I expect it to continue. I'm just looking for a quick scalp back to the reversion of the mean, which is the 50 MA. Now, let's look at the same chart, and where would we look to buy? Again, here's a traditional buy signal. Some people bought it. That bar makes a higher high than that bar, and then they get stopped out. We break the low of this low. So we wait for the mini divergence. Here it is. Lower low in price, little higher low on percent K. See that? So momentum shift, higher low in K, lower low in price, leads price. Now, where would we get in? Let's get super specific here. Okay, so once we get that mini divergence and percent K is angling up, I'm going to just put a buy stop in above the high of that little inside bar there. I'm going to make the market break the high of that little inside bar. As soon as it does, bam, I'm in. Literally just 1 penny above that high is all I need. Where's my stop go? A lot of you asked about stops. So to me, the principle of stops is the stop goes where you're wrong. In other words, you ask yourself, why did I take this trade? When the reason for me taking that trade is violated, then I want to be out. So I don't believe in using stops based on percentages or average true range or any of that stuff. Those are too wide for me. I don't like those wide stops. So for me, the reason I bought this is because, well, we got back above the 50 MA. The 50 MA is flattened and started to go up. I'm looking to buy the first retrace in a new uptrend now. And I'm buying a cycle low. So what's the lowest low of the cycle? Well, that bar. So my stop goes literally 1 penny below the low of that bar. Entry is 1 penny above that bar. So my stop is, my risk is minuscule. Now what's my reward? As I talked about, with trend trades, we are looking to catch the extended general direction of the market, a long-term move. So I consider an average trend to be 5 waves. And by the way, I used to be an Elliott wave trader a long time ago, and I love the principles of Elliott wave. They make sense, they're logical. The problem is I don't like the subjectivity of it. So I created my own ways of measuring waves objectively, so everybody gets the exact same wave count. So I'm looking for this. I'm looking for wave 1, 2, higher low, 3, higher high, 4, higher low, 5, higher high. So something like that would be my reward, and then that's my risk. So great risk-reward ratio. All right, so let's summarize here. We're just about done. All we're doing is we're waiting for the alignment of those 5 energies to put the odds on your side. And, you know, I went to a trading club. I was invited to speak to one of the largest trading clubs in the country, and I went out there, and I won't mention who it was, but the owner of the trading club, or the leader of the trading club, took me out to dinner, and his trading club, along with some of his other top people, friends, they were creating a trading methodology of their own. And they showed it to me, and it wasn't done yet, but so far it was over 200 pages long. And I thought, wow, that's quite a project. My trading plan is 1 sentence long. Okay, obviously I add to this, you know, money management and so forth, but it can all be pretty much summarized in this. Number 1, we're looking for trend. Are we looking to buy or sell? Is there even a trend? If there is, then I've decided which direction I want to trade in. Then the next question is it a strong trend or a weak trend? That's energy number 2, momentum. If it's a weak trend, I'll either not trade it or look to fade the trade, meaning I'll actually trade against the trend. If it's strong, then I'm looking to trade with the trend, and I move on to energy number 3. When do I want to get into that trend? And I use my second chance patterns on my cycle indicator to determine when to find the final low or the final high, so I get in and don't get stopped out right away. Because I'm buying and selling retraces, I go to energy number 4. I want to make sure I'm buying off support or shorting off resistance. And then finally, energy number 5, I look over the next higher time frame, and I've got to make sure that I'm trading in the direction of not trend of the higher time frame, but of momentum and cycle of the higher time frame. And once I have that, then I'm good to go. So the method is very robust, very adaptable. I use the same 5 energy method on stocks, commodities, options, currencies, futures. I trade all of these. I started out as a stock trader because that's what my dad was. And then I went to futures and, well, commodities and futures, and then to currencies, and then to options, and now I trade all of them. I also trade the same 5 energy on all time frames. So whether I'm investing in my retirement accounts or doing swing trading or day trading, it's just a matter of using different time intervals. And sometimes people ask me, well, how can you have one method that works for all markets and time frames? Because aren't some methods designed just for certain markets or time frames? And yeah, some are. But the reason that this is so robust and adaptable is because, well, we're just using objective instruments to measure whatever energies are on the chart. So it's kind of like if I had a turtle and I wanted to know the direction or the trend that that turtle was crawling in. I would use an instrument called a compass, right? And I could say, okay, that turtle is crawling east. Or I could pick up that turtle and put down a totally different kind of animal, like a cheetah. And that cheetah can take off and go 70 miles an hour. Completely different kind of animal than that turtle. Do I need a different instrument to measure the trend of the cheetah? No, I still use a compass because it just adapts to whatever. Same thing here. Whatever time frame you're using, whatever market, we're just using objective instruments to tell you on that chart what are the energies. So it's a very simple method, very objective, and we're pretty much just counting to 5. So that's it. That's my presentation. I'll open it up for any questions. And Oh, Kevin, maybe you can type in the link we have offer for you guys today, and not selling you anything. I promised I wouldn't sell you anything, so this is totally free. I've got a free 5-day video course that I mentioned, and each day for 5 days you get another free video. It's zero obligation. And at the end of each video, there's actually a quiz that you can get your answers right away to see if you followed it correctly or not. And it just teaches you some of the things that I do. Um, when I told you that on that trend pattern, that there was not a reverse head and shoulders there, I teach why that is not a reverse head and shoulders in this free video course. The rubber band trade I mentioned, I actually give away the rules and the details of that rubber band trade. It's one of my favorite trades. I still take that trade every single time it shows up because it's that reliable. Very, very high win-loss ratio. So yeah, Kevin, if you can give people a link as to where they go to get that, then that would be great. And while you're doing that, I will answer some questions here. Let's see. Got a lot of question coming in. Oh my gosh, we got a lot of questions. Hoo-wee. Okay, I'm going to have to go up. Okay. Wow, there are so many here. I'm probably not going to be able to get to all of them, but I'll do the best I can. Is it being recorded? I don't know. Kevin, is this being recorded? Yeah, I'm pretty sure Real Traders, I think they do record their webinars for the future. I'm pretty sure, but Kevin can tell you that for
Yes, we do,
sure.
Barry. They're being recorded. They'll be sent out by
Okay,
email
great.
this
Thank
weekend to
you.
everyone.
Ah, great. Okay. And yeah, can you type in maybe into the chat box there what the URL is, the website or the link that they would go to get the 5-day free video course? I think if you put it in the chat box, it'll stay there and not. I don't know if people can even see the question box for sure, but I think they can see the chat box. And maybe you can send that link also out in the email you send out. Oh, there you go. Oh, that's easy. Okay, great. There it is. I see it. Okay, let me answer some of these questions here. Wow, okay, this is a long one. Okay. Da, 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 da. Are we looking at a 5-minute time frame? Says Armin. Well, you can definitely use a 5-minute time frame. I don't have any particular. I don't believe there's any one time frame that's superior to any other. It varies depending on the market, but there are considerations in choosing your time interval. But as far as saying, well, is one time frame going to produce a higher win-loss ratio than another? Not necessarily, as long as, I mean, what we do is we look at things like how much volume is traded on the market in order to determine time frame. Also, the longer the time frame, the more risk you will have in the trade because of the wider range bars, and so you have to look at what your average risk going to be as you measure your cycle highs and lows and the range of those bars and see what percentage of that would be of your trading account. I prefer not to risk more than 1% of my trading account on any given trade. Also, part of it is psychological and how fast can you execute trades. Me personally, when I'm day trading, I use very short-term time frames. I like to go shorter than 5 minutes myself, but I can execute trades really fast. So you have to ask yourself, that's an individual decision as to how long does it take you to analyze the market, the potential entry, and then execute the trade. If you need more time, you want to use a longer term time frame. If you're quick on the draw, you can use a shorter term time frame. I wrote some articles about that and exactly how to, the considerations and how to determine a good time interval. And it will vary from market to market, again, depending on the volume traded in that market. And if you want, just send me an email at barry@topdogtrading.com, and I'll send you links to those articles. Okay, they're on the web, but I don't remember the links right offhand, what the URLs are anymore, because I wrote those articles a couple of years ago. But I can look them up, and I'd be happy to get those to you, and you can read all about it. Rick, why am I using tick charts? Yeah, I do like to trade tick charts, Rick. Tick charts are great, but you know, it's six of one, half dozen of another. Tick charts have some advantages over time-based charts like minute increment charts, but minute increment charts have some advantages over tick charts. So it's really personal preference. One is not necessarily better than the other. My personal preference is I like tick charts, and the reason, since you asked why, for me is a tick chart, by the way, for those who don't know, a tick in this context means a trade. So let's say, like for the E-minis, I use 1,000 tick chart. So each bar represents 1,000 trades because the E-minis just have massive volume. So I use 1,000 tick charts. So each bar will last for 1,000 trades. And that's regardless of the volume of each of those trades. So it's not really incorporating volume. So what happens is the faster the market moves, the more bars it creates. When the market slows down, it creates fewer bars. So when you get times of real slow market action, if you're using a time-based bar, sometimes you just get, you know, real meaningless bar patterns. Whereas with tick charts, it doesn't form any more bars, as many bars, and so your price patterns become more meaningful. Also, I have found in general at cycle highs and cycle lows, the bar ranges are not as wide as with minute increment charts. And since I base my risk on the trade, I'm buying, you know, putting in a buy stop right above a high of a bar and a low below the low of the bar when I'm buying. The range of those bars is important. The more narrow range of the bar, the less my risk on a trade. So those are the reasons that I like tick charts. Now, some of the disadvantages of tick charts, just to be fair. Tick charts, when the market does go fast, it's hard to time your entry sometimes because some bars will just form really fast, and it can be hard to time your entry because some bars will form slow and then all of a sudden they'll go really fast and you'll miss your entry. Another one is candlesticks. I use candlesticks, but if you're a real staunch advocate and really into all the different candlestick patterns tend to perform better on time-based charts. And so, like I say, just depends what's important to you. So on time-based charts, you can time your entries better because you know exactly when the next bar will form. You can just watch your clock and you know when the next bar is going to form to time your entry for the next bar. So good question, though. I get that a lot. So I'm sure that answered a question for a lot of people. Okay. Yeah, we get a lot of questions about momentum. I don't have time to go into all of that now. That's a huge discussion. That's like a whole nother webinar. So this one was about cycles, and yeah, momentum would be a whole nother webinar. I'm sorry, it's just not. I would love to tell you all about it, and obviously I do teach about that, but it's just too much to go into right now because not only would I have to share with you what the indicator is, but it's like the cycle indicator. I use a very common indicator. All my indicators, by the way, are very common ones. I don't use any proprietary indicators, nothing you have to buy or any of that stuff. But I do make changes to the indicator. So I'd have to show you again the new inputs for it. And then the key is, though, how to trade it, what patterns I trade. And that's what takes more time. I mean, even on the cycle indicator today, I could only show you one out of the 6 patterns I trade. Well, that's the key. Giving you the indicator and the inputs would be useless. It's the patterns that you trade that are what make it work. So yeah, I'll have to wait for another one on that. Okay, how do you know if it's weak or not? Well, momentum is what we look for there. And we look for either, now you can look for divergences on momentum, but when it gets down to 0, that's an indication that at least at that time momentum has come out of the market. How do I know when there's a new trend or not? A new trend is defined as really the angle of the 50-period simple moving average. Okay. Okay. Actually, a lot of people are just asking about the recording. Does this work in any time frame? Yes, it does. Yeah, I use the same 5 energy method whether I'm trading intraday, tick charts, minute charts, daily, weekly, monthly charts. Yeah, absolutely. Let's see. Okay. Okay, let me read this one here. Does a 50 MA show a true trend if not going for a higher time frame, such as 1 hour or high tick chart? Yeah, it does show a true trend, but trend is relative. Everything is relative. Trend is relative. Momentum is relative. Cycles are relative. Support resistance is relative. There's no such thing as the trend of a market. The trend is always relative to the time interval of the chart. So just as I've shown, you can have on a short-term chart trend going up and on a long-term chart of the same market trend going down. And that kind of, sometimes it's hard for people to wrestle with. Well, how can that be? What's the trend? That's the point. There is no the trend. On one time frame, the trend is up, and the other time frame, the trend is down. So how do you deal with that? Well, you choose a time frame that you're going to be trading, and the setup's based on that. And you're going to trade the trend on that particular time frame. So you choose a time frame, and you go with the energies on that time frame. Okay. What if the 50 MA is flat? Yeah, that is, well, we have rules for that. Generally, if the 50 MA is flat for a little period of time, then we consider that there is no trend. Now remember, the 50 MA is not the trend. 50 MA is the trend indicator. And as I said, don't rely on any one indicator for anything, because indicators do what they promise. They indicate. In other words, they don't tell. So yeah, by itself, it means nothing. But again, we're looking for the alignment of the other energies. So we can take trades when the 50 MA is flat, when the energy, because that's when we, especially when you're early into a new trend, we have, a trade where we do look for the first cross of price above the 50 MA after it's been below to get in early into a new trend, as long as the other energies align. Now, one of the things we look for is when the 50 MA is flat and price goes above and below and above and below and above and below the 50 MA, then we say there's no trend. But we look for it to cross the 50 MA and hold on one side of it in order to indicate that there's going to be a trend in that new direction. Okay, good question. Let's see here, so many questions. Okay, well, a lot of them are repeating though. The link for the 5-day free video course, it's not in the question box, it's in the chat box. Yeah, it's in the chat box. And Kevin put it over there so that it wouldn't get lost in everybody else's questions. Okay. Yeah, so he's gone, okay. Do I consider order flow when trading futures? So that's a good question. So, if by order flow you mean looking at a level 2 type screen, bids, asks, all that sort of thing, I don't. The old days of the SOS Bandit, SOES, are long gone. I've got a friend who trades the E-minis, and he trades 100 lots at a time. And I've sat next to him while he trades, and he games the level 2. He'll put in bids and asks and above and below the current price, and he's trying to actually move the market and fake people out, and there's a lot of people who do that. So that's not really, by most professionals that I know, really by any professionals that I know, considered a valid approach to trading anymore because it is gamed so much. And the same is true with stocks. Big traders are always looking to cover their tracks. They will bring in their orders through all different ways. So yeah, they are not going to expose themselves to be visible and make it obvious for you. Where would you have bought if there hadn't been an inside candle on that one trade? Okay, I would have bought, the rule is, after we get that mini divergence, I would have bought 1 penny above the high of the bar that created the hook up or the angling up of the %K line. That's the rule. That one just happened to be an inside bar. That really had nothing to do with whether I would buy that setup or not. The rule is 1 penny above the high of the bar that creates the hook up on K. Okay, since I'm buying. Okay, please say again, trade in the direction of momentum and what? Oh, and cycle. Yeah, so when I'm looking at the next higher time frame, I'm looking to trade in the direction of momentum and cycle on the higher time frame. Yes, but momentum's the most important one. And the reason momentum's more important is because it's not a bounded indicator. So if cycle is not within its bounded range, in other words, if it's not down at the bottom or at the top, or it can just be bouncing around meaninglessly because of its bounded nature, then I take into consideration cycle. But otherwise, I always want to trade in the direction of momentum. Here's a good question from Tim. Is the formula for setting the stochastic on different time frames? No. I use it the same on all time frames. Yes, good question. Rick, how can we get a copy of the indicators? Well, the indicator is in your charting platform. Stochastics is like the most common indicator that there is, so it should already be on your charting platform. Yep, just change the inputs as I gave them, and if you missed part of that, I know not everybody has been here for the whole webinar. Just, I guess, review the recording. You'll be getting an email. They'll give you the recording. All right, next one, Don. Barry, will you be going to the Traders Show in Las Vegas in November? Thank you. I learned a lot in your 5-day course. Oh, you already got the 5-day course. Great, Don. Thank you. No, I'm not. I don't do the trading shows anymore. I did years ago, and I enjoyed them because I really enjoy meeting the traders. That was the fun part. And I had a sponsor back then, and like I said, I did that for years, and then I just got tired of the travel and all that. So, but thanks for asking. Richard, do you scan for potential equities? You certainly can, and I have created formulas for scanning. Absolutely. Let's see. Brent asks, where can I get the other 5-second chance cycle patterns? Well, that's in my course. Yeah, it takes a while to go through all of that. So yeah, that's in my course if you choose to get that later. Let's see. Okay, for day trading and swing trading, what chart duration and technical indicators do you use? Well, I use the indicators that I showed today. For swing trading, I personally use daily charts and weekly charts. And for day trading, I use different intervals depending on the market I'm trading. So and that depends on the volume of the market. So a market with a lot of volume, I'll use a longer term chart. A market with low volume, I'll use a shorter term chart. And again, if you're interested in my articles about how to determine good time intervals for each particular market you're looking at, feel free to send me an email at barry@topdogtrading.com, and I'll send you a link to those articles. They're free on the internet. I just don't remember what the URL of those websites are. Lori, scoring, what ranks as a 1 or 0 and a 5 in each energy? Okay, so no, each energy can only be, it either supports the trade or it doesn't. So it's either a 1 or a 0. Okay, so then we add up each one, and if we get a score of 4 or 5, then our rules say we can take the trade. So it's either a 1 or a 0. In other words, if we're looking to buy, if the energy is aligning to the upside, it's bullish, then we give that energy a score of 1. If the energy is bearish or neutral, we give that energy a score of 0. It's just that simple. It's very simple. Brent asks, do I recommend the NinjaTrader platform? Yeah, I like NinjaTrader a lot. I use it. Most of the charts you show are 5-minute. Yeah, I don't know. That just happened to be, that's a coincidence. I don't even trade 5-minute charts, so yeah, just for me. Not that there's anything wrong with trading a 5-minute chart, just a very common interval. So it's a good interval to trade, but personally, I like faster charts. Gives me more trades per day and so forth. How often do you trade with 1 hour or daily charts? Yeah, well, daily charts I use all the time for swing trading. Hourly charts are good for something like Forex, for example. Hourly charts are very, very common for Forex. So that's a good one. What's my email address? It is Barry at Barry at topdogtrading.com. And Barry is Barry. Okay, next question. Do you add other things to your methodology depending on what market you're trading? I do have some volume things that I add to certain charts, and not only Forex or not only futures and stocks, but you can actually use volume with Forex, spot Forex, which is not widely known. But volume, see, these 5 energies are the energies I look for in every single trade. Now, are there some other things that I will look at from time to time? Yes, but they're not necessary for every single trade. So, and volume is one of them, by the way. And I know a lot of people put a lot of emphasis on volume. I don't put as much emphasis on it, but I do look at it. And when it gives good signals, I certainly take that into consideration. But volume does not give supporting signals on every single trade. Okay, let's see. We're getting a lot of repeat questions here. I don't use any other indicators for Forex trading. You just use the same thing. Yep. Okay, JD asked about range bar charts. Yeah, there is definitely a difference between tick and range bar charts. There's a huge difference. For my methodology, I don't use range bar charts. There are certain methods, and I know one person in particular who uses range bar charts. And his method, he's very good. He's a good trader, and his whole method is built around range bar charts. And that's fine. That's great. My method, see, I like to see extreme moves. So range bar charts smooth things out so much because they only plot bars when the market moves a certain a range, obviously. So it smooths things out too much. To me, those extreme patterns on tops and bottoms and movements and price patterns, those are all meaningful. I interpret those. That's part of how I understand what's going on in the market. So I like to see that. I don't want things smoothed out too much in my method. Having said that, I actually do have one student who wrote me and said he uses range bar charts with my method and he's doing great. So God bless him. All right. No, I do not have a live trading room where I can follow trades. I did have a trading room for a while. It was sponsored by futurestalk.net, and I did that for years. And honestly, I just got tired of it, because after a while, you're just saying the same stuff over and over and over and over, and it kind of distracted me from my own trading too. And so, yeah. But thanks for asking. I appreciate that. I actually do have some of my students who have a trading room, so that is an option for those who are interested. How may we learn your other patterns? Well, you buy my course. Dan, is the 50 MA simple or exponential? I use the simple moving average, and exponential would follow price more closely. I don't want it to follow price more closely. So I use the simple. No, there's no link to download the indicators. The indicators are already, they should already be on your charting platform. So if you missed that part of it, just watch the webinar replay when that's sent out to you. Okay, do you search for Fibonacci ratio confluences with support resistance zones to increase the strength of the signal to enter? Yeah, Fibonacci confluences like that, clusters. Yeah, they're good. They're fine. I look for them sometimes. I would do that more on swing trading than I would on day trading. And I would consider that it would add to the strength a little bit of that support resistance line. Absolutely. Can we take a trade when only 4 out of 5 of the energies are aligned, says Rick? Yes, you can. However, you have to have the only one you have to have is the fractal energy, the next higher time frame. That one is not optional. Okay, oh my gosh, I gotta go. I have a conference call here at the bottom in 4 minutes. So let me see if there's any other critical questions here. That haven't really been answered. Okay. All right, so yeah, I'm going to stop it there. A lot of repeat questions are coming in, which is fine. If you have any questions that I didn't get to, and by the way, there have been some, so I'm sorry for that, but I do have a conference call coming up in 3 minutes now, so I have to get on that. My time limit has reached the end. Feel free to send me your questions at, and you know what, I'll type my email in here to the chat box, okay? Barry@topdogtrading.com. There, I just typed it into the, oops, you know what? I did not send that to the entire audience. Barry@topdogtrading.com. There you go. Okay, so thank you, everybody. I appreciate your participation. You guys have been fantastic. I've really enjoyed this. Thank you so much, and I wish you all happy trades.
Barry, thank you so much for coming and joining us tonight. As always, what a great presentation. We thank you so much for joining Real Traders webinar and taking the time to come share with us. Have a great night. And everyone, we also want to thank you for taking time out on your Thursday nights, for coming to join us. Just to let you know, Deborah, Dave, Larry, Meredith, thank you all so much. There's so many names. There's hundreds of names. So I wish I could read them all. Guys, we will be getting the recording out, and we'll be sending it out by email. If you have any questions, you feel free to contact us at contact@realtraderswebinar.com. Again, thank you so much for joining us. Thank you, Michael. Thank you all for coming out and hanging out with us. Have a great night, guys.